2011, 2023, and now 2025. Those 3 years mark the moments where the United States lost its perfect credit rating from each of the 3 major rating agencies, one by one. On May 16, 2025, Moody's became the last agency to strip the US of its AAA status, downgrading it to AA1. And while most of the headlines treated this as a political story, the real consequences are now showing up in the one place that actually matters to you, your wallet. You see, a sovereign credit downgrade is not an abstract event that lives on Bloomberg terminals. It is a mechanism that quietly pushes mortgage rates higher, locks credit card APRs in place, and drains thousands of dollars out of households over the next decade. And right now, the data is telling us exactly how this plays out. The simplest way to understand what just happened is to think of the US government like a regular person with a credit score. When your FICO score drops, your bank charges you a higher interest rate on everything you borrow. The government is no different. Moody's downgrade signals that the world's largest borrower is now a slightly riskier borrower, and the cost of that perception gets passed down through every single loan in the economy. Now, the reason Moody's acted is not a mystery. Publicly held US debt just crossed 100% of GDP for only the 3rd time in history, the other 2 being World War II and the COVID emergency. The federal government is now borrowing roughly $50 billion every single week, and the interest payments alone have ballooned to $1.114 trillion a year, consuming 34% of all federal tax revenue. In other words, the United States now spends more on interest payments than it does on Medicare, or defense, or Medicaid individually. And so here is the mechanism that hits your wallet directly. When the government is viewed as a riskier borrower, investors demand higher yields on US Treasuries. The 10-year Treasury yield is currently sitting at 4.66%, near its highest level since the start of 2025. This matters because the 10-year yield is the benchmark for almost every consumer loan in America. The 30-year fixed mortgage rate tracks this yield plus a spread of roughly 2 percentage points. Right now, the average 30-year mortgage is sitting at around 6.5%. And the math here is brutal. On a typical $430,000 loan, just a half-point increase in your mortgage rate costs you an extra $150 a month, or roughly $54,000 over the life of the loan. The banks are not absorbing this cost. They are passing it directly to you. Now, many people will point out that when S&P downgraded the US back in 2011, Treasury yields actually fell, not rose, and the stock market recovered quickly. And that is absolutely true. But the 2011 environment was completely different. Investors were fleeing the European debt crisis and treating US bonds as the cleanest shirt in the laundry. Today, inflation is sticky at 3.8%. The new Fed chair Kevin Warsh is an inflation hawk who took office just days ago, and markets are now pricing in a 40% chance of an additional rate hike. The cushion that saved investors in 2011 does not exist today. And this is where the real damage is hiding. The average credit card APR for Americans carrying a balance is now 21.52%. The average household with credit card debt is bleeding roughly $1,400 a year in interest alone. New car loans are averaging 7%, used car loans 12%, and auto delinquencies just hit a 32-year high. Total US auto debt has reached a record $1.68 trillion. If you are carrying variable rate debt right now, you are in the danger zone. If you are waiting for mortgage rates to magically fall back to 3%, Fannie Mae and the Mortgage Bankers Association both project rates stay above 6% through 2027. And if you are financing a new car on an 84-month loan at today's rates, you will pay nearly $6,000 more in interest than a 5-year loan. But here is the part that nobody on the news is telling you. This exact same environment is creating one of the best windows for savers in over a decade. Top high-yield savings accounts are paying up to 5% APY, and top certificates of deposit are locking in 4.2% on a fixed multi-year basis. The national average savings rate is a pathetic 0.38%. So the gap between what most people are earning and what is actually available right now is enormous. And so the playbook from here is straightforward. Audit your variable rate debt and attack the highest APR first. Lock in fixed yields through a CD or a CD ladder while rates are historically elevated. Do not pause your automated index fund contributions, because every prior downgrade in 2011 and 2023 has rewarded the investors who stayed consistent. Delay finance purchases you do not absolutely need, and focus more on growing your income than on cutting your expenses. A US credit downgrade sounds catastrophic on the evening news, but mathematically it just means borrowing got more expensive. If you avoid new variable debt, lock in the high yields available right now, and stay consistent with your long-term investing, you will not just survive this shift in the economy, you will come out ahead of the 90% of people who are panicking. Thank you for watching.